Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go to that top story of the morning, and that is Boeing. So that stock up, let's see, I think we're just up by about 1% here, as David Calhoun will be stepping down as CEO, but not until the end of the year. Apparently he's going to be intimately, I made that word up, but he's going to be involved in his replacement, which I also think is quite interesting. So I want to go to George Ferguson. He's the guy. Yep. He's the airline guy that you got to go to. He is Senior Aerospace, Defense, and Airlines Analyst, joining us now in Princeton. All right, George, your reaction to the news that we saw earlier, and then we'll walk up to what's next.
Yeah, so my reaction was, I think we thought Dave Calhoun probably would be going. I hate to sort of wish that in anybody, but it seemed that, the problems in the manufacturing business, there were just too many of them over too long a period of time to say that he was as effectual, if that's a right word, as he should have been at bringing everything, back into order. It does seem weird that it's going to take them till the end of 2024 to find his replacement. There's a lot of things that have to happen between now and then that the company just can't wait for. Things like the purchase of Spirit Aerosystems, which should improve reporting lines, should improve the stability of the production process and the quality process. That's super important. They've got to serve to the FAA their view on how they're gonna stabilize their production process. That's coming due here too, and at the same time, right, they've got to start to increase build rates so they can improve profits and cash flow. They can't wait a year on that either. So there's a lot of super important things that are happening this year. To wait till the end of the year to replace a CEO that doesn't seem to have been able to get that job done well seems like a lengthy timeline to me. But it may just be that the board was flat-footed in realizing that the CEO had to go and is nowhere in a search, and so they've got to start from scratch here and figure out who the next person is.
What can you tell us about Stephanie Pope? She's going to be stepping up and taking a bigger role with the aircraft business.
Yeah, so she's been around for a while, and she's been the CFO of that aircraft business. So it seems like a logical inside choice. It may not be the final choice there, although it may well be. But I think when you have a head of that department, Stan Deal, who's leaving after 30 plus years at the company, they're hard shoes to fill. And then you look around internally for who could be the next person. The CFO is always in particularly decent shape because they understand at least all the financials about the business. She's also had positions at Boeing Global Services, which is a super successful business inside Boeing, high teens margins. To me, the only thing I don't see in her background is that manufacturing skill set. Mm-hmm. I think the next CEO and the next head of Boeing Commercial Airplanes has to really have a manufacturing, engineering mindset background, and I think that's what I don't quite see there.
Sort of like a Larry Culp?
I mean, Larry obviously is pretty busy, and honestly, the job he has now at GE could be better profits, more fun than Boeing, because there's a lot of great technology inside GE, and there's a huge bow wave of a lot of maintenance coming that's really high margin. I think you'd really have to work hard to get Larry Culp
George,
out of there.
I mean, does he like fun or does he like a challenge? I mean, he was the one that went to GE to begin with.
Sorry, you broke up a little bit there. Say again.
Oh, I was saying that, does he like fun or does he like a challenge? Because he was the one that went to GE in the first place when it was a hot mess.
I do think he likes a challenge, and I think he showed his ability to navigate it really well at GE. But again, they're just kind of getting to the super fun part. I think there's still challenge inside GE, but he's just getting to the point where he's got aerospace broken out, and he can really make a lot of hay here. So, someone like him is absolutely what I think Boeing needs. I don't know. Maybe he's got maybe there's a protege somewhere inside there that they could tap or something.
So, thinking about who could be the next CEO here, is the expectation, George, that it'll come from an external candidate or internally? And are there any early front runners, do you think?
Yeah, so I definitely think it's going to come external, right? I just think the fact that you've seen this purge of the CEO, you've seen the purge of commercial airplane president, means that we've depleted some talent there. You look, there was former heads of Boeing's commercial airplanes that had left, when Muhlenberg came on. They could potentially be, in the running for something like this. I know that a couple of them wanted the CEO job and didn't get it, but I'm almost positive you're talking about something that's going to be outside. It's Ray Connor's the name that comes to mind. Used to be the head of Boeing commercial. I'm not sure what he's doing now, but he might be on the list somewhere.
What's the culture like at a Boeing in terms of getting an outsider?
I think Boeing is one of those companies. I think you get a job and you stick around for lots and lots of years, and so. I think that bringing people in from outside is something you do only when you have a breakdown like you've had now, right? Under normal circumstances, there would be very clean lines of succession inside Boeing. You would move up through the ranks and expect opportunities as you rose. But there's been so much tumult in this business over the last, 4 years or so, that I think that it's a time in their history where they're going to be going outside a lot more to replenish some of these senior management ranks. So they've turned over a bunch of it.
And George, it seems like this is no quick fix here. It seems like it was years, maybe even decades in the making in terms of maybe the deterioration of some of their quality controls here. When you talk to industry folks, people at Boeing, is there a pathway to kind of get back to where they were in terms of quality?
I think there is, but it's a lot of attention to detail, and like you said, it's slow work. So you can't sort of wave a wand, I think, and make it happen overnight. Really, I think has a lot to do with people and processes, right? And that's why I think you want someone like a Larry Cope who loves people and processes. You need, and that just takes time. You need a lot more. You need training. You need, in the interim, you probably need to beef up some of the oversight. You need to get into your supply chain. You need to give them a hug. You need to help them out. Help them bring you quality products. I mean, it's not a hey, how are you going to make my margins work better in the next couple of years discussion, right? It's really, like I said, it's people and processes. It's the softer side of management. I think Boeing over the last decade or two really was more into the how do I squeeze you to get you to give me products at a cheaper price so I can build my margins. There's it's what is it? Recipe for success. It wasn't that wasn't quite the term, but there was a term like that Boeing was using with their suppliers, and it was all about squeezing them. So the supply chain is all they've been scarred. They're worried about when Boeing comes to talk to them, and I think they need to get to a world where when Boeing shows up, they think someone's there to help them and is looking out for their best interests. Partnering for success, sorry.
I love that idea, though. It's like you just need a hug and be like, we got this, guys, versus like squeezing out of the suppliers. It's just like a great visual for a manufacturing giant like Boeing. George Ferguson joining us. He is Bloomberg Intelligence, a senior aerospace, defense, and airline analyst. I think it's going to be so interesting. Like, how do you even start a search like this?
Yeah, I guess as George was suggesting, a couple attributes you need, engineering expertise and manufacturing expertise. This is not a marketing story. It doesn't feel like it's a strategy story that you go to like a consultant or something. It's just nuts and bolts manufacturing as George has told us in the past, at the highest tolerance levels you can ever imagine. Making an airplane is a little bit different than making an automobile. Yep. In terms of tolerances and things like that. So I would guess that there's relatively a small pool of people that kind of fulfill that.
I also wonder what the timing is for that. Like, knowing that there's a small pool of people, like, why do this right like today, but then wait for the rest of the year? I think
it just feels like this was tied into the news we got Friday about, certain members of the board are going to go on a listening tour with our big clients without the CEO. I think that it feels to me, at least, some of these big airlines said, you know what, you need to make a change there at the top. And we need to see that started now. And I think they probably just kind of stewed on that over the weekend. and this is the decision may come up. So we'll stay on top of that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix, I'm seeing a red headline across the Bloomberg terminal here. Trump bond reduced to $175 million in New York fraud case. So I guess that's a piece of good news for the former president. It's a lot better than the $454 million he was staring at.
And then if it was 120% to post, it was even more than that. He has said last week that President Trump has almost, I'm quoting, $500 million in cash, and that he will use a substantial amount of that to fund his campaign to return to the White House. In a court filing, he did claim that he'd need closer to $1 billion in reserves to cover the bond and still have enough cash on hand to run his sprawling real estate company. So, I mean, anything at that point, $300 million reduction potentially helping him as well. Trump has said that the cash crunch had emerged after 30 insurance companies that arranged such bonds refused to take any of his properties as collateral. So the latest headline is that his bond reduced payment for President Trump now to $175 million in that New York fraud case. Remember, the overall penalty was $454 million, and you usually have to pay more for that bond.
Yeah, so the question is, does he have the cash with, wherewithal to make that $175 million, satisfy that $7,500 million bond? I guess that's the next question, but that's something that I think that would have to be answered again today, right?
I have no idea.
Yeah.
This is why I'm not a lawyer. And also I should point out, but he's also sitting for one of his criminal cases too.
Yes, I guess I see some video shots of the courthouse in Manhattan. I guess this on the hush money payments. Apparently that is also going on today down there. So again, I think on the margin, a piece of good news for the former president. His bond reduced to $175 million in the New York fraud case. So again, I guess the next steps will be just how does former President Trump and his team, how do they satisfy that bond?
Do they keep fighting it, or I think he has 10 days, right, to deliver that money? So is there anything that needs to be
something
sold?
was due today. I thought today was on the former bond. Maybe this is a new bond or something.
Well, this is that President Trump must pay that $175 million bond within 10 days.
Okay.
That's the court. So it gives him some time, I think, to get it together. So I wonder where that comes from.
Yep.
And how that winds up coming from there. Joining us now is Erik Larson, Bloomberg Legal Reporter. I saw him. He literally ran from his desk. So don't mind if he's a little out of breath. Were we expecting a reduced bond here?
I would have thought that if they were going to reduce it, they would have put it at the $100 million request that Trump had made, because he had said that was the maximum he was able to actually arrange. So it'll be interesting to see if Trump says that he can go ahead and do this larger one.
So, but if nothing else, it buys him another 10 days. Are we reading that correctly? That he would have had to satisfy that $454 million bond today, but now with this reduction, it kind of starts the clock again. Is that?
Exactly. So that definitely, for now, the New York Attorney General won't be trying to seize his assets, which was the big fear starting today.
So can you just wrap this in? So what was the argument? Like, how did they arrive at that 175 from the 454? Like, what is the conversation around that? And is that the normal conversation we would hear from anybody who was going and trying to get the fine reduced?
Well, it's a pretty unusual situation to begin with, just because normally with damage awards this big and bonds this big, they involve like really big Fortune 500 companies or things like that. And as Trump's lawyers argued, for a privately held company, the Trump organization is huge, but not as massive as some big corporations, that it was just really difficult for them to arrange a bond of this size. So it's all kind of novel. It's an unusual situation all around. Haven't had a chance to read the whole decision yet, but I think the appeals court just decided to have a little bit of mercy on him, while still putting him under some pressure to arrange a bigger bond than he says he was able to.
Okay, so that's that. So we have, I guess, 10 days to get to the next chapter here, but former President Trump is still going to be down in a courtroom in Manhattan today, right?
Right, that's correct. He has a hearing in what is probably going to be his first criminal trial. They haven't scheduled the new date for that yet. It was supposed to start today, but they delayed it because of some new evidence. So he's been in court with his lawyers this morning. his lawyers have been getting grilled a bit by the judge in that case. So it'll be interesting to see what happens with that trial. They could set a new date for that today. It could be as soon as next month.
And what is the argument here? Like, which one's this one?
This is the so-called hush money case.
Okay.
He's accused of falsifying business records to conceal hush money payments to a porn star before the 2016 election.
And he still had such. Okay, so we got this one. And there's still some other things going on, right?
Right.
I mean, the January 6th case, is that federal in Washington? And do we have any sense of timing on that?
I wish I knew. We still don't have any dates for the other 3 trials. Not yet.
Other 3 trials. You got to keep on top of it.
Yeah. I mean, do you have like an Excel spreadsheet there?
Yes.
Okay. You do. Okay. He's literally not kidding. Just one more question on the bond here. What is your question now? Now that we know the actual number and it's in that weird spot, higher than he said he could pay, but much lower than the original, what is your question?
My question now is, are they going to stand by what they said, which was that there was no way in the world they could get a bigger bond than $100 million? Or are they going to say, okay, fine, and circle back and try to see what they can do? Because he said that if it was anything more than $100 million, he'd be forced to sell some assets in order to raise that extra cash, because those companies that arrange bonds won't take his real estate as collateral.
All right.
It's a head scratcher. Although I guess 75 million is better than adding on 400 million.
Yeah,
Right.
Yeah. So I mean, it's
that.
probably a good day for the president today, just from how the math works. Erik, thanks so much for
problem.
literally running down
Literally.
here from your news desk to get us the latest here. Erik covers all the legal stuff for Bloomberg News.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
On Friday, S&P posting its best week of the year. Plus, last week saw the most amount of S&P 52-week highs in nearly 3 years. I thought that was a really fun
that's a good
stat, right? That's a good one.
That kind of goes to the breadth of the market.
Exactly.
Yes,
So it's not just about tech. And we'll kind of see this play out as well as tech comes under attack in Europe as well as the chips in China. So joining us now to discuss is Katerina Simonetti, a Senior Vice President, Private Wealth Advisor over at Morgan Stanley Private Wealth Management. Katerina, are we going to expect the same kind of momentum within the S&P and the overall U.S. stock market next quarter?
Alix, thank you for having me on the show. What an incredible start of the year. We're really first 3 months in, and Dow is already approaching 40,000. At least we're, seemingly a few trading sessions away. And the real question is going to be, are these price levels of equities are going to be supported by earnings? We're about to approach this, quiet time, which usually what happens, the bit of an information vacuum is something that we see between the earnings sessions. But when we come back with new earnings session in mid-April, the question really for that pricing, that tailwind for the prices in equities to continue going higher will be all up to earnings, and we're priced to perfection now. The question is, what can we expect going forward?
So how do you feel about valuation in this market? Some folks are saying, hey, if you strip out some of those magnificent 4, 5, 6, whatever the names are today, you pull those out, the market's valuation seems okay. Do you do that, or how do you think about valuation?
Well, the biggest question that we get from our clients is, when is the good time to take the profits off the table? When is the good time, to really realize some of these earnings? And it's a really difficult question to answer, because we can never effectively call either the top or the bottom of the market. But we know that there are certain prices, that are higher than we've expected them to be in certain areas of the market because of AI, because, some technologies, some companies that are, looking to increase their profitability through this investments in AI, but this is not the time to be enamored with growth. This is the time to take the total picture into account and not give up on value just because this bullish outlook in the market.
What does value mean to you? I feel like this is like a deep question, but what is value to you right now?
Alix, for many, many years, one of the staples of diversified portfolios have been this blue chip dividend paying stocks. And this is the sector in the market that has not performed quite as well as this exciting growth names. But, the areas like consumer staples, healthcare, financials, materials, industrials. In the long run, when we think of AI story as a whole, all of these sectors stand to benefit, and the value of having these blue chip dividend paying stocks in the portfolio, plays a huge role in risk management. The other side of it, this is, beyond your questions about the value, but also small and mid cap, stocks and the role they play, in this total portfolio construction. So there are a lot of areas in the market that did not have this huge run up. So this will be a good time to take maybe a little bit of a profit and move into some of the areas that are positioned for growth.
Looking for maybe different sectors that might be opportunistic. One of them is energy. I just look at WTI crude oil up another 1.7% today. We're just about $82 a barrel in WTI crude oil. How do you think about the energy space here? Again, I think there's a little bit of concern about where are we in this transition to green energy? Is it slowing down? How do we think about that?
We're enthusiastic about the green energy and sustainable energy, but we're not quite there yet. And yet the broader energy sector is under pressure because of the overall geopolitical environment. With that said, the demand for energy is very strong. So we like energy as the sector that plays a role in the portfolio. Energy companies, pay excellent dividends, and because of the strong demand and increasing demand in the world, and the fact that we're not quite ready to switch into the green energy sources quite yet, we hope this happens soon. But for now, we love having energy exposure in our portfolios.
So to that point, Paul, for the quarter to date, we have communication services and tech. Okay, they're the top performers in the S&P, right? That's an Amazon big tech story. But energy is up over 11%. Yeah. Financials up 10%. Industrials up 10%. Materials up 6%. I mean, and if you just look at the last month, it's really been those guys, the financials and energy and industrials, that have really been outperforming. Do you think, Katerina, that the movement into those kind of names will help offset any weakness in tech?
Well, of course, Alix, and this is not to say that we should give up on tech.
Sure. But the rotation will be enough to support the headline level.
Absolutely. It is really the story, the real story, in my opinion, is really the fact that all these innovations in tech are going to have across the other industries. And the fact that when we look at the previous year, the underperformance in these sectors, the valuations that look attractive, the competitive positioning, the fact that these companies have been very smart with their costs, they're running, the good models, and their prices are looking attractive, especially when we think about the environment where we're expecting few rate cuts, and it will be easier for these companies to broaden their profit margin in the environment where rates are a little bit lower than where they are today.
And Katerina, last week was a week of for much of us to hear from the central bankers around the world, and I guess the tone coming out of not only the Fed but some other central banks is probably a little bit more dovish than maybe people had thought going into last week. What's your take about how the Fed is going to kind of behave over the coming months?
Well, it's hard to know what they're going to do. And even if we look at the projection of expectations this year alone, we started in January expecting 4 to 5 rate cuts. And right now there are opinions out there that there will not be rate cuts at all. At Morgan Stanley, we still expect that we're going to have 3 rate cuts, and that Fed is, at this point is positioned to do just that. But what we tell our clients is that they should not necessarily, adjust or make drastic changes in their portfolios based on the Fed action. In the going forward, of course, any type of rate cuts we get is going to be the economic stimulus. It's something that is going to benefit the economy in the long run. But in the short run, it is really more earnings, labor market, overall, strength of the economy that is proven to be much more resilient than we thought.
And then to that point, I wonder then if the way to express rate cuts, whether it's 3, 2, or 1, because I think it was Bostic was really talking about maybe 1 cut. You also have Lisa Cook speaking right now. She says disinflation has been bumpy and uneven, and cutting too late could wind up hurting, and cutting too soon could also hurt on the growth and then the inflation front. So if you're trying to game that out, how do you express that?
Well, I think that one clear action right now is to take advantage of the higher yields in fixed income while they're still available, because, it seems like we've had money market rates at 5% forever, but it really only has been a short time frame while this has been available, and Fed is going to react based on economic data. I think that we can expect some type of rate cuts, and there is that also immediate reaction. Historically, large cap stocks react very positively. There's almost this delayed reaction in small and mid caps. So if we look at the effect of the rate cuts, whether we get 3 this year, whether we get less, whether they're pushed into 2025, but Fed is going to react to economic data, and we're paying attention to the same numbers.
All right, Katerina, thanks so much for joining us. Really appreciate it, as always. Katerina Simonetti, she's the Senior Vice President, Private Wealth Advisor at Morgan Stanley Private Wealth Management, joining us from the town of Brotherly Love, Philadelphia, via Zoom here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, a story that is out there for the technology companies. It seems like we've seen this play before. The European regulators, they're not too happy. They take a much heavier hand in terms of a regulatory oversight
They
to
do love them regulations.
some of the big U.S. technology companies. I'm thinking Apple, I'm thinking Google, I'm thinking Meta, and that's back in the news here today. Mandeep Singh joins us, senior tech analyst for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker studio. So, Mandeep, those of us of a certain vintage like myself, I can remember back to the late 80s, early 90s when it was Microsoft that really was under the regulatory microscope of the European regulators. And the net result, it seems, if I think back, was just a lot of checks being written, a lot of fines being paid, but nothing more than that to the overall business model of Microsoft, i.e. there's still that Office bundle and so on and so forth. Talk to us about what's going on from Europe today as European regulators look at some of these big U.S. technology companies.
Yeah, and just to start off with that Microsoft comparison, I think one thing that did happen was a change in behavior. So you could expect something similar with these companies, even though it's unlikely they're going to be broken up because of this, but you can expect a change in behavior in terms of how they operate. And the reason I say that is Microsoft was an operating system company.
Yep.
They were layering on their Internet Explorer browser. What the regulation intended to do was to decouple the two in terms of giving more choices to the users. You're seeing EU kind of pretty much play to that point where these companies, Apple and Google, they have the operating system, they have the App Store, they bundle a lot of their own apps, right? So you have to use their App Store, give them a 30% commission, you have to use Safari browser, you have to use Google Maps. So that's what I think regulators are focused on. I think they're probably 5-10 years too late. I mean, look at, all these... Well, the reason why they're so big is because they operated like this for the last 10 years.
But this is such a great point because I don't want any of that to change because it'll make it more annoying for me to do stuff on my phone. So to your point of it being too late, in the beginning when I was adopting the iPhone, maybe, but now that's just a pain. Yeah. Is this going to hurt them to make this case?
I mean, regulation is always an afterthought. We have seen that time and again.
Yeah,
it comes in too late. And look, in this case, they are vouching for more open app stores. So instead of Apple taking a 30% cut and forcing everybody to use their payments platform, it's about having third-party platforms. Now, the one caveat there is, if you bring in third-party platforms, guess what? Google can launch their own app store on iOS. Right now, Google App Store is used in Android. If you start opening up the platform, who does it benefit the most? I would argue Google, because then they can put their App Store on iOS. You can pay through the Google Android App Store on iOS. So I think, in effect, even though the regulation is well intended, it may actually end up, favoring Google if it turns out to the way I think it is, because the likes of Spotify, Netflix, they're not going to create a new app store. It's peanuts when it comes to saving on payments costs. Like, what are you getting out of investing so much in developing your own app store? Yes, it's good to have an open platform. That's what Epic has been arguing, and all the gaming companies. But I think the one company it benefits the most here is Google.
That's actually pretty funny.
All right. So just real 30 seconds. How are investors thinking about this risk, the regulatory risk for these big tech companies? How are they thinking about it?
I mean, it's different from different companies. I think the operating system gatekeeper analogy applies to Apple and Google specifically. For Meta, they want you to pay to subscribe to the apps if you don't want to be tracked. Now that's interesting, right? We are so accustomed to using social media apps as free because our data is what they use for targeting. If you don't want to be tracked, you have to pay Meta, and I think that's not going to be palatable for users.
So I love Mandeep cuts through it, right?
Yeah,
like
right,
now I get it. All right, Mandeep, thanks a lot. Really appreciate it, Mandeep Singh, joining us from Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
35 years on Wall Street, I've had the pleasure of working with some really, really good groups of people, and none better, Mount Rushmore type, were the people at Payne Weber, 1986 and 1989. The Management Audit and Control Group, don't ask, it's top secret. Mike Sullivan ran that group, and pretty much everybody in that group went on to have a pretty darn good career, and none more than my man, Joe DaGrosa. He's the chairman. He's the CEO of Axxes Capital. I'm scared to ask what Axxes Capital is, but he is in Miami, Florida, and he did that decades before it became trendy here. He's been down there kind of running money down there for a long time. Joe, thanks so much for joining us. You're one of the all-time greats. Tell us what you're up to at Axxes Capital these days.
Yeah, well, first of all, that throwback to the mid-'80s just dated me. So,
Exactly.
But it's nice to hear your voice. It's been way too long. A few things. I've been down here in Miami 26 years now. I moved from Payne Weber and joined a private equity firm that turned out to be pretty successful, and launched my own firm some years ago, and so run a family office as well as a private equity shop down here in Miami.
So what are you guys doing in the markets here today? I'm guessing you're not running a 60-40 portfolio, Joe.
Clearly not running a 60-40 portfolio. Our main focus today, as you can probably see by the background, at least for viewers who are watching the live stream, we're focused on, with Axxes Capital, introducing interval funds, really focused on this massive underserved market of accredited investors, folks with sort of 1 to 5 million that represent the mass affluent that up to now really have not been able to invest in private investments. So we think the next big wave in the capital markets will be a significant reallocation among, I'll call it the mass affluent, into private investing because they're living longer. They need to match assets and liabilities and make sure they don't outlive their income. And so we're building a suite of products that we believe will serve that accredited investor market very well.
Okay, we're burying all the leads here, people. What was Paul like in the 80s?
Paul was fantastic. I mean, I have nothing but fond memories, Paul. It's been too long, and I know we're due to have a reunion pretty soon, but Paul was a great guy to work with. He really was.
It's funny. We had a great group. Again, I've got my Payne Weber group. I got my Chase Manhattan group, my Solomon Brothers group. The Payne Weber group, almost person for person. I'm talking a couple dozen people went on to have really good careers. We kind of thought Joe was going to be the black sheep, but he's ended up doing the best here. He's still at it here. Joe, you mentioned private credit here. That's been a market that I've been really amazed to watch develop really over the last 10 to 15 years. It used to be kind of private equity was the place you go for some outsized returns. How do you guys think about private credit?
Well, look, I think private credit has stepped in where the banks have walked away, and regulations on the banking side have made it, challenging for banks to maintain market share in that space. And so you've had a proliferation of funds, private credit funds getting into this space. And of course, Paul, as you know, interest rates have been on the side of credit for a long time, up until recently, up until 22, but they rode a 10, 15-year wave of a declining interest rate environment. So the total returns have looked particularly strong in that space. I think what we're going to see now, prospectively, is the major comeback of private equity. I think that's going to be the place to be over the next 5 to 10 years, notwithstanding a lot of talk about capital flowing into that space over the years.
Okay, first of all, you guys are both seriously disappointing me of what Paul was like 20, 40 years ago, but whatever, we'll let that slide. Wait, you said private equity? Because I feel like hasn't the whole thing been, no, private credit, not private equity now?
Well, it's interesting. I mean, there's, I don't know, 80 or 90 interval funds now in the credit space, maybe a dozen equity funds. So, people have been chasing returns and they've been looking in the rearview mirror. I think the future looking forward is allocations to private equity. And I'll tell you for a very simple reason. People are living longer. They, clearly, there's this massive generational transfer of wealth from a risk-averse generation to a risk-tolerant generation that I think is more informed. They know they're going to live on average 3 to 5 years longer, than their parents or certainly their grandparents, and they're going to have to allocate capital accordingly. And that means over the long term, as we know, equities over the long term, trounce fixed income, notwithstanding what's happened over the past 10 years.
So, Joe, you were, as you mentioned, you got down to South Florida way before it became trendy here. Talk to us about how Miami has changed just over the last 4 or 5 years. I mean, kind of pandemic. It seems like everybody and their brother's moving down there.
It's really been incredible. I mean, I've been down here, as I said, roughly 26 years, and we've seen more change in the past 5 years than we saw in the prior, call it 2021 years. And I think that's, certainly driven by COVID, and no question about it. But I think COVID, in concert with technology, has made people realize and has accelerated the understanding that you can be most anywhere in the world and work. And why not be in a beautiful place? I mean, when I moved down here, it was really driven by the fact that I had an opportunity to join a private equity shop, and it could have been in Tuscaloosa, it could have been in Idaho. Now what we're seeing is I'd call it the sort of that Malcolm Gladwell tipping point here in Miami, where you almost have to be here as a firm. If you're in the wealth management space, if you're in the private equity space, you have to be here because this is where the action is. And it's a great quality of life. And, we all know taxes are far lower down here.
Oh,
so,
man, you're killing Paul right now. You're literally killing him, Joe.
Exactly.
I'm sorry.
Yeah. All right. So talk to, what is it? You mentioned interval capital, Joe. What is that concept?
Well, it's Axxes Capital is our firm, but we're really focused on launching a suite of interval funds. And it's really this simple. The Investment Company Act of 1940 basically says if you're super rich, a qualified purchaser with $5 million or more, you can invest in private equity and private credit funds. There's that line of demarcation, though. If you are not a wealthy investor, $5 million or more, you're basically shut out. And there's only one way to offer products to accredited investors, folks with between 1 and 5 million, and that's to register your vehicles. And that's the safe harbor under the Investment Company Act of 40 that says if you register your vehicles, just like sort of like an IPO, then you can bring in an unlimited number of, I'll call them smaller investors. And, what we're seeing is there's $15 trillion among accredited investors, about 1% invested in private investments. Compare that to qualified purchasers, folks with 5 million or more, who are at 10% allocated to private investments. Goldman Sachs' most recent family office report says that family offices are 27% invested in private investments. So we believe the future is in the smaller investor.
Yep. Joe, great to talk to you again, buddy. Always good. Always knew you were doing well down there in South Florida, doing it way before anybody else was. Joe DaGrosa, he's the chairman and CEO of Axxes Capital, based down in Miami, Florida. We both started our careers, Payne Webber, June 16th, 1986.
Amazing. Okay, so what was Joe like?
Funny. The really funny guy in our group. We actually just had a great group of people. We're still very tight. We get together every year or two, dinner at Smith & Wollensky's in Midtown Manhattan. People come in flying from all over the world to come in and kind of hook up because for a lot of us, it was the first job out of college, and it was a really tight group, and we stayed tight throughout the year. So it's a good group, good way to start your career.
I love this story.
Yeah, and see, that's the example I bring up. If you're working from home, you don't get that. And I'll tell you what, that's what it's all about for me. So good stuff. Check it out.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.